Hi, I'm Anthony Greco, a senior manager in the national office. Today I want to share some perspectives on foreign currency, and specifically, hedging foreign currency risk. Many companies are dealing with currency volatility due to a broad strengthening of the dollar versus other major currencies. This volatility is reflected in a multinational's operating results. The foreign operations are being translated into fewer US dollars, and companies are looking to mitigate that volatility through currency hedging. Because of this, it is critical to align risk management strategies to the different types of currency risk. We then need to understand how those strategies may impact the related accounting. Let's start with the types of risks. There are three risks that companies try to mitigate through hedging. Transaction risk, which occurs when an entity has transactions denominated in other than its functional currency. Economic risk, which occurs when a company expects to purchase goods or sell products in a currency other than its functional currency. The third risk is translation risk, which occurs when translating the financial statements of a foreign subsidiary from its functional currency to the parent company's reporting currency. To help put these in context, here are some examples of these risks and related strategies to address them. Let's start with transaction risks. Say there is a US business that has receivables denominated in euros. We would say that the entity is long euro. That is, if the euro increases in value versus the US dollar, the entity benefits. However, if the euro decreases in value, the entity is hurt. In order to hedge this risk, the entity could enter into an equal euro short position with a financial institution through a simple forward contract to sell euro and receive US dollars. From an accounting perspective, the gain or loss on the receivable would be offset in earnings by the loss or gain on the forward contract. Next is economic risk, which occurs when a company expects to purchase goods or sell products in a currency other than its functional currency. For example, a US entity has a European subsidiary that makes sales in euros. The company is economically exposed to changes in the euro to dollar exchange rate, even though the future purchases or sales are not yet recognized. Using their forecast of future euro sales, the company could enter into various contracts and designate them, from an accounting perspective, as a hedge of these future sales. The third risk is translation risk. Say a US company is translating a subsidiary's euro financial statements into its US dollar reporting currency. The translation impact on the net assets of the euro-denominated subsidiary can be hedged from an accounting perspective with a net investment hedge. However, a net investment hedge only addresses the net assets. It does not affect the impact of translation on earnings. So, what are the takeaways? First, hedging a risk doesn't mean you have to use hedge accounting. In our transaction risk example, the company entered into a derivative to hedge the volatility of the foreign asset. The change in value of the derivative offsets the volatility in the income statement due to foreign currency. This is known as an economic hedge. So understanding the intent and underlying instrument are key. Second, there's a difference in hedging an existing transaction versus a future transaction. The economic risk example highlighted this by using future purchases or sales. Because future transactions are budgeted estimates, this may result in increased exposure in the effectiveness assessment. Lastly, as we noted, a net investment hedge does not address earnings. What it will affect are your assets and liabilities, which could impact your financial metrics. So as you can see, understanding the linkage between the risk, response, and the related accounting is critical to achieving accurate reporting in this complex area. For more on these topics, refer to PwC's Foreign Currency Guide available on cfodirect.com.